10 days from now, the biggest IPO in the history of the stock market goes live. Bigger than Saudi Aramco, bigger than Alibaba, bigger than anything Wall Street has ever seen. SpaceX is listing on June 12th under the ticker SPCX, targeting a $1.75 trillion valuation and trying to raise $75 billion in a single day. And here's the thing that nobody is actually saying out loud. The people who buy SpaceX on day one might be the ones who get left behind. Today, I'm breaking down the 5 space stocks that matter most right now, which 2 I'm most comfortable owning heading into the listing, and which 3 could get hit hard the moment the money finally has somewhere better to go. So leave a like, subscribe, and let's get into it. So what's actually happening? So let's make sure we're all starting from the same place, because the SpaceX IPO is genuinely historic, and the numbers are worth understanding. Saudi Aramco held the record for the largest IPO ever. It raised $29.4 billion when it went public in 2019. SpaceX is trying to raise $75 billion. That's more than double the previous world record from a company that's been private for over 2 decades. At a $1.75 trillion valuation, it would instantly sit among the 5 most valuable public companies on the planet. But here's the detail most people skip over. SpaceX is using a dual-class share structure. Elon Musk will control 85.1% of all voting power after the IPO. You, buying Class A shares on the open market, get 1 vote. Musk's Class B shares get 10 votes each. So you're buying a piece of the upside, but you have 0 real say in how the company is run. That's not necessarily a deal breaker, but it's something you should walk in knowing. Now here's where it gets interesting for the stocks already trading. Names like Rocket Lab, AST SpaceMobile, and Redwire have been running hard because SpaceX wasn't available to buy. Investors poured into the closest public alternatives, but on June 12th, that changes, and when something has been hyped for months and finally becomes available, the early money often sells. Think of it like a restaurant with a 6-month wait list. The moment they expand and anyone can get a table, the exclusive crowd quietly moves on. The framework: picks and shovels. Before we get into the individual names, I want to give you a mental model that will make every stock in this video make more sense. During the California gold rush in 1849, most miners went broke chasing gold. The people who actually got rich, the ones selling the pickaxes, the denim jeans, the shovels. They made money no matter who struck gold and no matter who went bust. The space race right now works the same way. 2 questions cut through all the noise. Does this company already make money, or is it purely a bet on the future? And does it need SpaceX to win, or does it win no matter what SpaceX does? Keep those 2 questions in your head as we go through each name. Okay, now let's get into the 5 stocks. But before that, if you like more content like this, make sure to hit that subscribe button so you don't miss out on future videos like this one. And I hope you enjoy the rest of this video. The first name, and honestly the one I keep coming back to, is CACI. Most people know them as a defense tech contractor. They build cybersecurity systems and data infrastructure for the Pentagon. But CACI has quietly become a real space company. They acquired a business called ARKA that builds electro-optical sensors flying on low Earth orbit satellites. They build one of the few American-made laser terminals that let satellites communicate directly with each other in space. And they just advanced to Phase 2 of the U.S. Space Force's Enterprise Space Terminal program, a $100 million initiative, as one of only 3 companies selected. Now here's where I want to slow down, because the numbers here are genuinely impressive, and most people aren't talking about them. In fiscal year 2025, CACI did $8.6 billion in revenue, up 13% year over year. Net income, $599.8 million. They've printed a profit every single year for over 2 decades, and their total contract backlog as of December 2025 sits at $38.2 billion. That's almost 4 years of revenue already signed and waiting to be recognized. They're also buying back their own stock, which is management telling you they think the business is undervalued. CACI doesn't need SpaceX to win. Satellites still need to talk to each other. The Pentagon still needs space infrastructure. CACI builds the pipes, not the rockets, and they get paid every time a satellite goes up, no matter whose rocket carried it. The second name that I think flies under the radar is Karman Holdings, ticker KRMN. This one only went public in February 2025, so a lot of people still haven't heard of it. What they do is make the physical components that go inside missiles and rockets, the nozzles, the payload fairings, the structural parts that end up in things like the Patriot, the Stinger, and the Javelin missile systems. If a rocket or missile is being built in America right now, there's a reasonable chance Karman made something inside it. What sets Karman apart in this basket is that it's actually profitable, and the profits are growing. Full year 2025 revenue came in at $471.5 million, up 37% year over year. EBITDA margin is 30.8%, which is genuinely strong for a manufacturer. Gross margin sits above 40%, and their contract backlog just crossed $1 billion for the first time in Q1 2026, up 38% from a year ago. The growth driver here is Pentagon missile spending and launch infrastructure demand, not the hype cycle around SpaceX. That's the whole point. Now let's talk about the three names that are real businesses but carry real risk heading into the listing. And I want to be clear, I'm not saying these are bad companies. I'm saying understand what you own. First up, we have Rocket Lab. It's the closest thing the public markets have had to a SpaceX proxy. They build their own rockets, they launch payloads, and over half their revenue now comes from building satellite systems for other people. Revenue grew 43% last quarter to $200 million, and they have a $2.2 billion contract backlog. That's the good news. The harder part, they're still losing money. Last quarter was a $40 million net loss. Free cash flow last year was negative $321.8 million, and the stock currently trades at roughly 91 times sales. To put that in perspective, for every single dollar of revenue Rocket Lab earns, the market is paying $91 for it. There's almost no room for anything to go wrong. On top of that, the company has a shelf offering open to sell up to $3 billion of its own stock over time, and SpaceX explicitly named Rocket Lab as a direct competitor in its IPO filing. When money rotates into SPCX, it has to come from somewhere. The 91X names are the obvious first stop. Next, we have AST SpaceMobile. AST SpaceMobile is the boldest swing in the group. The vision is genuinely compelling. Satellites that beam standard cell signal directly to the phone already in your pocket. No special hardware required. They have FCC clearance for 248 satellites, working hardware in orbit, and carrier deals with AT&T, Verizon, and Vodafone. But right now, they're generating almost no revenue while burning hundreds of millions of dollars a year. And the valuation? About 260 times projected 2026 revenues. It's also caught in a double squeeze. It competes with Starlink for the direct-to-device market, and it depends on SpaceX to actually launch its own satellites. When SpaceX filed its IPO prospectus and named AST as a competitor, the stock dropped 11% overnight. That reaction tells you something about how exposed it is. The third stock is Redwire, and it's the one that sits somewhere in between. They build the actual infrastructure that goes on satellites and space stations, solar arrays, docking hardware, avionics, and they recently added a defense drone division on top of that. Revenue has grown 15x in about 6 years, which sounds incredible, but the losses have ballooned alongside it. And they fund a lot of that growth by issuing new shares, which dilutes existing investors. Jefferies downgraded the stock after it had surged 163% in just 30 days, calling valuations stretched, and the stock dropped nearly 15% on that call alone. It's more of a compliment to SpaceX than a direct competitor, but the valuation still requires a lot of things to go right. So, when you step back, this entire basket really comes down to one question. Does the company need the hype to win, or does it win regardless? CACI and Karman have real profits, strong backlogs, and growth drivers that don't depend on SpaceX going public. Before buying any space stock, check two things: its price-to-sales ratio and whether it has positive net income. Those numbers reveal far more about risk than the headlines. The flashiest stocks get the attention. The profitable ones often get the returns. And if you want to learn more about what's hot in the ETF side of things, make sure to watch this video where I go over the best quantum computing ETFs on the market right now.